Welcome. My name is Robin, and I'm your capital advisor. Glad you can join us today, where we will be talking about year-end strategies for getting a business loan next year. So with that, we'll just get started. First, I want to say thanks and to acknowledge the support from Prosper Portland for providing the support of these and the other videos that we produced as part of their Inclusive Business Resource Network here in Portland, Oregon. So today's agenda, we'll talk about what lenders look for in your financials, and then we'll talk about why now, why year-end, why is it important, and then we'll go over a few year-end strategies. This is a relatively short video, so hopefully we'll be able to cover this in just a few slides. So first off, let's talk about financial statements. The owner's view of financial statements, right? You got three financial statements typically: the profit and loss. And that's really to help owners kind of see, how's revenue doing? Am I keeping the costs manageable? How much profit do we have? All kind of standard profit and loss type information that can be deduced. Then we have the balance sheet. The balance sheet pretty much summarizes, what do we have? What do we owe? It just shows the summary of your various accounts that you have in your business. And then finally, there's the statement of cash flow. It's not often used as much for businesses because a lot of times the profit and loss can also substitute in some degree like a statement of cash flow, but it really identifies how much cash you have coming in and going out of your business. And the question that a business owner can ask is, am I generating sufficient cash? So these three statements, or these three financial statements, do a pretty good job of describing the financial health of the business. However, if you take a look at the lender's view of these financial statements, they're going to look at this from a different angle. They're going to really primarily say, hey, can this business repay the loan? Or how risky will this loan be? So they'll look for information on your profit and loss and say, are they generating enough profits to repay the loans? What are the trends? Is the business trending up, trending down, growing revenue, growing profits, flat? Whatever the case might be, they're looking for trends to see how the business financials will continue, especially if they provide the loan. They'll look at the balance sheet and usually assess risk. Is there too much debt, right? There's no debt or there's a ton of debt. Obviously, if there's a ton of debt, that represents risk. What are the assets for collateral? Is the AR good? If the AR is too big, that's a little warning sign that the customers are not paying, and that could impact future cash flow and their ability to repay the loan. And then they look at the statement of cash flow. Is there sufficient cash to make the loan payments? And so to get approved for a loan, your financial statement must demonstrate your ability to repay the loan. So why year-end? Why is it important? Why is it important to do things, at this time of the year? Well, year-end is the financial statements that give a good full year review of your financials. So just kind of soup the nuts, the whole full year is a nice snapshot. It's easy to provide year-to-year comparisons, and your data is also aligned with the tax returns that you submit and that they'll ask for as part of the underwriting and application process. So making strategic year-end changes can bolster your chances for getting a loan next year. So first, just talk to your financial advisor and kind of identify what year-end financial accounting changes can I make to boost profits and keep desired revenue and cost trends, on the up and up. What can we do to reduce debt, improve cash flow, or clean up the financial statements? And I'm not suggesting that you make up numbers or whatever, but there's a lot of latitude, when you're managing your finances to affect, these characteristics or financial characteristics of your business. So talk to your financial advisor and see, what things can we do to kind of make the financials shine a little bit better in the eyes of a lender. First strategy I'll go over is increase profits. And again, I'm not suggesting that you make up the numbers, but there are things you can do to increase revenues for this current fiscal year. One is, invoice before the year end. Generate, some additional revenue that you can kind of wrap in this year versus next year. provide some as incentives to close contracts and generate revenues before year end. Maybe give the client, if you have a big deal or a big opportunity, give them some financial, some incentive, and it doesn't have to be a discount, by year end. And, kind of maybe consider, having some sales to unload slow moving inventory. These are just assets sitting on your balance sheet that are not generating any revenue. They probably won't. So conduct a sale, get it out of your inventory, start the year with a cleaner inventory, and end the year with a little bit more sales that you can kind of, generate or increase your revenues. The other thing you can do is also decrease costs, and that is, deferring expenses into January. There's nothing wrong with moving. Every month you make decisions as to where you're moving, spending your money. You can, defer some expenses into January so that those costs don't appear in your current fiscal year. Keep in mind that increasing profits will all likely increase your current tax liability. Which, many small business owners, I was one myself, we never wanted to pay taxes. So we always kind of, did things to decrease our profits year end, so that we don't generate a year-end tax liability. But when you're doing or planning securing a business loan, you have to increase your profits. You have to demonstrate profits because it's profits that repay the loan. So unfortunately, it's kind of a catch-22. You increase your chances of getting a loan, but then you have to end up paying, more taxes. So obviously not an easy decision. And that's another conversation that you should have with your financial advisor to see, what you can do, where's a sweet spot maybe that you can pursue to achieve both minimizing taxes and increasing profits so that, you look better in the eyes of a prospective lender. Next up is, increase your cash flow. Again, like profits, cash flow is what, demonstrates your ability to repay a loan. So if you're showing, good cash flow, you're showing that your ability to repay the loan. Two things that you can do is, one, collect AR. Maybe you have some old AR, maybe it's, accounts receivable that's over 90 days. Too much AR, especially old AR, is a red flag in the eyes of lenders. So do what you can to convert that AR into cash, and increase your cash flow for this current fiscal year. Another thing that you want to do is liquidate or sell unwanted assets. It could be inventory, it could be equipment, maybe you have some old furniture, whatever assets that you have in your business that are not needed, you're not really using, free it up, sell it, and convert it to cash. And you'll have more cash flow for demonstrating your lending purposes. And that cash flow that you generate, you can use to pay down liabilities. Maybe you have some accounts payable or other debt. Again, too much debt, too much liabilities is a red flag from a lender's perspective. So so instead of necessarily only generating more cash flow, but you can also pay down liabilities and other debt to improve your balance sheet. We talked about, in the last slide, paying down your debt. So if you have extra cash, and I know this is a little bit of oxymoron, if I have extra cash, why do I need a loan? Maybe you don't have enough, extra cash to fully, equal the amount of loan that you're requesting. So, maybe if you have a little bit of extra cash, consider paying down your AP, accounts payable. Consider paying down expensive debt. Maybe you have some credit card debt that they're charging 25% interest on. Get that off your balance sheet, pay it down, save some money, free up some cash flow, and pay down the expensive debt. Likewise, delinquent debt, right? Maybe you have some debt that is just old and the lender is kind of, or creditor has been patient, but it's still delinquent. Old debt, delinquent debt is again a red flag for prospective lenders, because they're saying, well, if they can't pay this debt and they're 30 days, 40 days past due on this debt, how are they going to repay my loan? So you want to be able to get rid of any delinquent debt that you have on your balance sheet. So pay that down, get it off it, and if you're able to completely remove that debt, then they're not going to ask that creditor, what's the history with that, right? So if you get them off your balance sheet by year end, they won't see it, they won't pay attention to it, and you don't have to worry about them asking that creditor whether or not the history or the circumstances of that debt. Overall, reducing debt will decrease the risk to prospective lenders. The next strategy is to clean up financials. A messy financial statement represents risk. And so if you have a nice, organized, clean financial statement, it's going to look good in the eyes of lenders. And it's kind of like the first impression that a lender will have, right? If the financial statements look like messy, they're going to immediately start having reservations about lending their capital to you. So a few things that you can do is making sure that your financials are clean and well organized. First off, no negative numbers on any of your financial statements. The financial statements are designed to portray generally positive numbers. So if you have negative numbers, that means something is not exact or appropriate with your bookkeeping or accounting, especially on your balance sheet. So if you see any negative numbers on your financials, talk to your bookkeeper or accountant, see what you correct whatever issues may be behind that. Make sure that account classifications make sense. It's very common mid-year, you have the expense, you don't know where to put it. You create this account, just kind of a placeholder, and you leave it there. But it doesn't really make sense to a third party. So look at your financial statements from a third party perspective with a fresh eye. And make sure that all the account classifications, the names, they all make sense. And then also, this also includes not just your high-level reports, but your detailed reports, like, accounts payable, accounts receivable, debt. These are likely reports that the prospective lender is going to ask for, right? And so you want to make sure that, these reports are also clean and that they make sense. And then finally, just resolve any outstanding discrepancies or lingering issues. You just want to clean them off, get them off your balance sheet so that when you are on your financial statements, so when you send those in, they don't ask questions about it. So clean it up, get rid of those issues, and so they won't ask about it. The other thing you can do is start planning for next year. Right? It's year end, you probably started planning for next year. And so develop a lendable budget, forecast, and plan. And again, I'm not suggesting you make up numbers, but as you develop your plans, show that you have sufficient profit and cash flow to, repay the desired loan. Maybe there's something that you can do with marketing to increase, your marketing strategy, increase sales. And by tweaking a little bit, you can, generate a little bit more sales to justify the loan. That's what I'm talking about. Profits, you want to structure your profits so that they're 120% or more of your anticipated loan plan payments on an annual basis. And we have another video on that called How Much Can You Borrow that goes into much more detail. So I encourage you to look at that to figure out how you can figure out what that proper amount is. And there's also templates and worksheets are included with that video. Make sure your current asset to debt ratios, improve. Current assets and current debt ratios, meaning, these are assets or debt that, can be repaid within the next, next year. So it's fairly liquid assets or fairly, short-term debt. Make sure those ratios improve as the year progresses, because that demonstrates your ability to repay the loan and reduces risk from an eyes of a lender. And then, make sure that your monthly cash flow forecast has sufficient cash to service the loan. And that's also, again, covered a little bit in the How Much Can You Borrow video. So again, another reason to look at that video. So that's all we have, So that's all we have. It's a short video, but just a few kind of year-end strategies, to increase your odds for getting a loan next year. Thank you for joining us, and we look forward to talking to you next time. Thank you.